We begin, as always, with 3 things investors ought to be thinking about right now. Markets were on rocky footing this week. What you should be watching for as earnings season continues. Then, bonds are staging a surprising rally. Is it too late to get in? And the Treasury Department now taking special steps to avoid a government default. What the debt ceiling drama in Washington means for the market and your investments. On the Barron's Roundtable, my colleagues Ben Levisohn, Andrew Bary, and in from D.C., Megan Cassella. So, Ben, it's been kind of a rocky week on Wall Street. We even actually saw the NASDAQ leading. Can you kind of make sense of what we're seeing right now?
Sure. If you look just at the Dow, it was down 2.8%, and it looked like we were just going back to that selling that characterized 2022. And you had the Fed again talking about rate hikes, and then it was going to keep going. It was going to keep them there for a long time. But then you looked over at the NASDAQ, and it actually squeaked out a gain this week. So I think it's hard to make too much of what's going on with the markets right now. It really looks like a lot of repositioning out of what worked in 2022 and into the things that didn't work to see if they can maybe do better this year.
So while investors are doing that and focusing on the U.S. side, might there be a reason to look overseas?
Well as the NASDAQ has done this year compared to the Dow, China up 15% so far this year. Europe is up almost 9%. And that has to give you a little bit of pause because those are some pretty big gains in less than a month worth of trading. But the United States has done so well for the last 10 years on the back of those tech giants that it's really possible that you're going to get some very good international outperformance over the next few years.
So coming back to the U.S., we are about 2-3 weeks into earnings season, a lot of data to digest. What are you going to be looking at in the coming weeks?
Well, first I'm going to look at Microsoft. It's going to give a read on how tech is doing, a better one than I think Netflix did this week. Netflix got the market excited because they got more subscribers, but Microsoft has cloud business, has enterprise, and so it'll really tell us maybe a little bit about how Apple and Google will do. We also have Boeing coming on Wednesday. People will go on to know how their business is doing. They've had a tough time, but it looks like people are ordering more airplanes. That would be good. And then we have Chevron. A lot of bears now in energy because of how well those stocks did in 2022. Chevron will give a hint of whether they're right or wrong.
All right, so Andrew, I'm going to take you to the other side of the portfolio, which is the bond side. After a really rough 2022, it seems like they're taking off. Can you tell us what's going on?
Well, bonds are back after one of the worst years on record in 2022. I mean, bonds have staged a rally this year, and yields are down probably 1/4 to 1/2 percentage point across the board right now. And you've seen rallies not only in Treasury bonds, but in municipal bonds, corporate bonds, preferred stock.
So, okay, with this rally, is it too late to get in?
I don't think so. I mean, I might emphasize shorter maturity treasuries, 1 to 3 year treasuries. They're like ETFs like ticker SHY. Convertible securities look interesting, which offer a play not only on bonds, but also on a stronger stock market. And you can also look at inflation-protected securities called TIPS. And so there's some ETFs like ticker TIP for that.
So, investors sometimes have a difficult sense of, what's driving the bond market. Help people out. What should they be looking at over the next few weeks, few months on how things like inflation are going to weigh on bond valuations?
Well, the big driver, I think, so far this year has been optimism about inflation. Inflation is cooling off. Inflation has only run at about a 2% rate in the last 6 months. So that's encouraging. And I think investors are hopeful that the rest of 2023 will see similarly good numbers. There's certainly nothing like what we saw in the first half of 2022.
Excellent. So talking bonds, we're talking debt. We had to bring in our big guns from D.C. Megan, tell us, we are coming up on this debt ceiling talk. It just seems to be something that happens every few years. What is at stake now?
Yeah, it's something remarkable, right? Because it has the potential to completely rock the economy and markets, and yet it's exceedingly unlikely to actually happen. But it could, so we have to focus on it. So Republicans are really dug in now. It's a quirk of Congress that they have to vote periodically to lift their own debt ceiling, to pay for some of the spending that they've already approved. Republicans have the House majority, a very narrow majority. They're saying we're using this as leverage. We want to see some pretty significant cuts, likely aimed at pretty expensive pieces of legislation or programs like Medicare and Social Security. Democrats don't even really want to engage. They say we have to do this. This is a hostage-taking situation, and we don't even want to work on this. We should just pass it because it's what we have to do to keep things in regular order. President Biden has pretty much shrugged off any suggestions that he move unilaterally to to fix this, but it does mean that we're at an impasse. They have to find a way to work together.
So as we're going to this impasse, when might we actually kind of see this come to a head? Give us kind of a timeline of what to expect over the next few months.
So we actually already hit the debt ceiling this week. That's why we're seeing this fresh round of headlines. Treasury Secretary Janet Yellen can use what Treasury calls extraordinary measures to move money around, to buy Congress some more time. That X date, though, is June 5th. Washington doesn't do much without a hard deadline, so we're going to be talking about this for the next several months. We likely won't see a deal until closer to then.
Okay, and just real quick, as we get closer to that date, right now markets don't seem to mind, but do you anticipate any market volatility around that June 5th date?
It's a big question what the long-term impact is, but certainly it could get more volatile because we don't have to get all the way there in order for there to be some impact. We saw in 2011 that Standard & Poor's downgraded U.S. debt for the first time, even though they did make a deal. And so we don't have to get all the way to that X date for something to happen.
Excellent. Well, thank you very much.